Welcome to today's Explainer. We are jumping right into a complete stock due diligence report on CNB Financial Corporation, which trades under the ticker symbol CCNE. If you've been keeping tabs on the regional banking sector lately, you know it's a space that absolutely requires some careful digging right now. So today, we're going to break down the raw numbers, the latest SEC filings, and the newest analyst reports to see exactly what is going on under the hood of this specific bank holding company.
Right off the bat, let's tackle a critical question that's probably on your mind. Is regional banking actually poised for a breakout? Following all the recent shifts and consolidations we've seen in the financial sector, regional banks with strong deposits and clean balance sheets are suddenly drawing a lot of attention. Our goal today is to figure out if CNB Financial actually fits that winning profile.
We're going to unpack this using our standard due diligence blueprint. We'll run through the company and industry overview, check their financial health and earnings, look at valuation and market sentiment, break down dividends and shareholder returns, dig into the institutional data and risks, and finally, wrap up with our takeaways and market outlook.
Section 1. Company and Industry Overview. Let's start wide, with a look at what CNB Financial actually does day-to-day and where they sit within the broader industry landscape.
So CNB Financial isn't just some single small-town local bank. They're actually a multi-brand regional powerhouse operating across 4 states: Pennsylvania, Ohio, New York, and Virginia. They run 79 different offices, acting as the parent company to highly localized, recognizable community brands. Think Erie Bank, Bank on Buffalo, and their newly integrated ESSA Bank division. They even operate a specialized division called Impressia Bank, focusing specifically on banking opportunities for women. This localized branding is super smart. It lets them build deep community trust while keeping the back-end strength of a much larger institution.
And the sheer scale of this operation is what's truly interesting. We are looking at a market cap of roughly $1.01 billion, but that sits on top of a massive $8.4 billion in consolidated total assets. To put that into perspective, that makes CNB Financial a very substantial player in the regional space. They're large enough to benefit from economies of scale, but still nimble enough to provide a highly personalized wealth management, trust services, and commercial banking to their local communities. Section 2. Financial Health and Earnings. Let's see how this multi-brand footprint actually translates into profitability, specifically focusing on their recent operational results and that transition from Q1 to Q2 of 2026.
The crucial takeaway here is the clear, undeniable upward momentum. In Q1 2026, they delivered a really solid $26 million in net income. But in Q2, they actually beat analysts' expectations, growing that net income to $27.2 million, which comes out to 91 cents per diluted share. Total revenue also saw a really healthy jump, going from $83.3 million up to $87.6 million. A huge driver for this profitability was the successful integration of that ESA Bank acquisition we mentioned, alongside some great organic growth in their commercial and industrial loan portfolios.
Now, before we look deeper into their profitability, we need to quickly define net interest margin, or NIM. It's literally the absolute lifeblood metric for any regional bank. Basically, it just measures what a bank earns in interest on the loans they give out versus what they have to pay out in interest on the deposits they hold.
In Q2 of 2026, CNB's net interest margin climbed to a very healthy 3.88%, which was a nice little bump from 3.83% in Q1. According to the CEO, Michael Peduzza, this favorable margin was supported by a realized reduction in their average cost of funds, along with increased momentum in their commercial loan portfolio. Simply put, they're lending out money efficiently and keeping their own deposit costs well under control.
Section 3. Valuation and Market Sentiment. Knowing they're profitable and expanding margins is fantastic, but we need to shift gears and look at how the market is actually pricing that profitability right now.
When we dive into the valuation metrics, the data is pretty compelling. We've got a price-to-earnings, or PE, ratio of 12.33, which is fundamentally solid for a regional bank. But check out the 5-year beta. It's sitting at 0.63. A beta under 1 means the stock is historically way less volatile than the broader market. Yet, despite that lower volatility, this stock has grown an impressive 44.13% over the last 52 weeks. It's capturing significant upside growth without subjecting you to those wild roller coaster price swings.
And management is playing smart defense too. In Q2, they made a massive, highly strategic move to protect that exact valuation. They actively called and retired $50 million of their 3.25% subordinated debt. Why did that? because it was about to reset to a much higher floating interest rate based on current economic conditions. By paying this off early using their strong equity base, they successfully shielded their bottom line from rising debt servicing costs.
Section 4. Dividends and shareholder returns. For a lot of folks looking at the financial sector, the income profile is just as important as the growth thesis. So let's break down CNB Financial's dividend data.
Right now, CNB Financial pays an annual dividend of 76 cents per common share, effectively rewarding you for holding the stock while they continue to grow the underlying business.
That 76 cents translates to a 2.20% dividend yield. But here's the best part. Look at the payout ratio. It is just 23.49%. This is a highly conservative, incredibly sustainable approach. They are paying out less than a quarter of their earnings as dividends. That leaves them plenty of retained earnings to fund future acquisitions, protect against loan losses, and easily maintain or even grow this payout over time.
Section 5. Institutional data and risks. No explainer is complete without popping the hood to see who actually owns the stock and what specific risk factors could potentially derail this bullish thesis.
Looking at the ownership breakdown, institutional backing is remarkably strong at nearly 65%. When major funds hold this much of a regional bank, it generally signals deep confidence in the management team and the long-term stability of the asset. Plus, the latest short interest data sits really low, with only 2.56% of outstanding shares being sold short. So the smart money is broadly betting on the bank's continued success, for sure.
On the risk and liquidity front, one standout event in Q2 was that they intentionally exited a $140 million municipal deposit relationship. Now, why would a bank voluntarily let deposits walk out the door? Well, because they were just too expensive, carrying a high average interest cost of 3.49%. The key takeaway here is that CNB's massive $7.1 billion total deposit base absorbed this impact effortlessly. Actually, if you exclude that one planned exit, organic deposits grew by over $71 million in the quarter. However, there is a crucial point on the risk side that absolutely requires monitoring, and it involves their asset quality. Total non-performing assets rose from $49.2 million in Q1 to $58.4 million in Q2, which now represents 0.69% of their total assets. According to their SEC filings, this uptick was largely isolated to one specific $8.5 million commercial and industrial relationship rather than some broad, systemic failure in their loan book. Still, any rise in non-performing assets in today's economic climate is something you have to keep a close eye on.
Section 6. Takeaways and Market Outlook. Let's pull all these threads together: the expanding margins, the strategic debt reduction, and that slight uptick in non-performing assets to see what the analysts are projecting for CNB Financial moving forward.
Overall market sentiment and analyst ratings lean positive. Recently, Keefe, Bruyette & Woods reaffirmed their market perform rating on the stock, but notably, they bumped up their price target from $35 to $37. With the stock recently trading around $34.60, this implies an additional upside of roughly 6.9%, and that's not even including the 2.2% dividend yield you'd be collecting while you wait.
To summarize our explainer today, CNB Financial is demonstrating some really impressive financial health. They've delivered consistent quarter-over-quarter growth in both revenue and EPS and successfully integrated their ESA acquisition. Their net interest margin is expanding up to 3.88%, and management is proving highly capable by strategically extinguishing expensive debt. You get a very safe, well-covered 2.2% dividend yield, but as an investor, you must monitor those rising non-performing assets in the coming quarters to make sure credit quality remains stable.
So based on the verified data from their earnings reports, their strategic multi-brand footprint, and their solid profitability metrics, we want to leave you with this final thought. Does this regional banking powerhouse offer the right mix of growth and income to justify a spot in your diversified investment portfolio? Ultimately, that's the question you have to answer. Thank you so much for joining us for the Stock Due Diligence Explainer. Keep learning, keep analyzing, and we'll see you next time.